So our last in the series of podcasts having to do with adjusting entries is going to deal with accrued expenses and accrued revenue. Now, when we use the term accrued or accrual, we simply mean that something is owed. So an accrued expense is an expense that has been used but not paid for yet. So it is still owed. That's why there's an accrual. If you're talking about a revenue, accrued revenue, it means that you have done the work to earn the revenue but have not been paid. Sometimes you call that accounts receivable. So accrued revenue you don't see mentioned very often except when you first get started because it has other names like accounts receivable. Accrued expenses actually tends to keep that name throughout our discussion. Throughout the semester. So what we're going to do is illustrate these concepts with the concept of a loan and interest. So we're going to start with number 8 on the sheet you see in front of you and say that company A borrows $60,000 from the bank. As we get rid of some of our leftover from the last illustration. $60,000 cash from the bank. So how would that be recorded? Well, certainly we have cash go up for $60,000, and if we're borrowing the money, that's a liability. We can call it a loan payable or a note payable. We can use those interchangeable, and because it's a liability, it needs to increase with a credit. So there is the actual loan. Typically, that would be recorded whenever it happened. Now we have the money. Now, interest is the cost of using somebody else's money. So we're renting this money from the bank with the idea that we eventually have to pay them back the $60,000. We have to return the money to them. In the meantime, interest is being charged on the money. For every day we utilize this money, we owe the bank interest for using their money. So we go back to our list of events, and we say the bank will charge company A 12% interest. So that's the rate that we pay, the rent we pay or need to pay on the money. They do not have to pay the interest until August of 2013. So while we are utilizing the money, we don't have to actually write a check to pay for that until next year. So we get kind of a reprieve in terms of how much when we have to pay the cash. How much does the company A owe in interest on August 31st? Now, notice the amount is how much we owe. It doesn't matter how much we've paid because we won't pay anything until next year. But that's not the point. The point is we've been using their money for a month. So we owe them interest for a month. So to calculate interest for a month, we take the total loan, $60,000. We multiply that by the 12%, which is 0.112, which gives us $7,200. And then we divide that by 12 to get just the interest for 1 month. So that would be $600. So after 1 month, we have a liability to the bank for not just the $60,000 now, but the $60,000 and the $600 on top of it. So we go to our T accounts, and let's see how we might record this. Since it's an additional liability, we might be tempted to put it in with our loan payable, but probably we're going to pay it separate, so we want to track it separate. So the interest is going to be a payable, a liability, for $600 after 1 month. Now, interest is an expense. So we go over here to expenses, and we'll overwrite our insurance expense with interest and count that as a debit to interest expense. So we credit interest payable, debit interest expense. No cash involved because we're not going to pay cash. But just because we haven't paid cash does not mean that we can't record or shouldn't record the amount of the interest that has happened just because time went by and we utilized their money. So that would be the answer to number 10, the debit to interest expense and credit to interest payable. How much interest would be owed to company A on December 31st? Well, at December 31st, it would be August, September, October, November, December. 5 months of interest. Each month would be $600, so that would be $3,000 owed. What would be wrong if Company A failed to record this interest on December 31st? Well, you would have too little liability and too little expense. What would you make? What journal entry would you make on December 31st if you had remembered to make one in August, the one we showed here, but you forgot for September, October, November, December, because you should have made all the rest of them? Well, that's 4 more months you forgot. So 2,400, 4 times 600, and 2,400. So the total interest that we have, the rent on that money, since we've rented it for 5 months at $600 a month, the expense is $3,000 because the expense is because we've utilized their money. We haven't paid it, so it's still payable, interest payable on December 31st for $3,000. Record, just as we said, $3,000. All right. So the point with accrued expenses is you may have not paid for it, but you have utilized the expense. So you have to record an expense, a debit, and a credit, a payable. So it could be utilities, it could be wages that people have worked and they have not been paid yet. All right, all of those need to be figured out at the end of the accounting period to make sure we have not missed any expenses, because otherwise our net income is going to be too high. We'll look like we are doing better than we thought than we should be looking, and our liabilities will be too low. Now let's flip that and look at it on the other side. What if we're the bank? Now we're the bank making the loan. So we go back to our T accounts and pretend to be the bank. The bank is going to give up $60,000 in cash, and it's going to have an asset called loan receivable. So it was a loan payable for the borrower. It's a loan receivable for the bank. Debit and credit. Debit, credit. No change to net assets with the actual loaning of the money. But of course, the bank is planning on earning interest with that loan, right? That's why they're renting out the money. We go back and it says, what would the journal entry be for the bank? How about August 31st? Now, what's happened? 1 month later, we know the interest is $600. Has the bank been paid any of that $600? No. So, it has interest receivable of $600. They've done what they are supposed to do. All they agreed to do is let them have their money. They're not providing any other services. So that means it is revenue, interest, revenue, credit for $600. That's revenue. This is an asset, debit, credit. So the moral of the story is for every payable in the world, there's a receivable. So the company who borrowed the money has an interest payable. The bank who loaned the money has an interest receivable. The bank that made the loan has a loan receivable. The company that borrowed the money has a loan payable. So payables and receivables should be the mirror image of each other. Accrued expenses and accrued revenue should be the mirror image of each other. So we look again at our sheet there. How about December 31st? That's 4 more months. Receivable, still no cash. And then we have the 3,000. So just like before, where they had a payable of 3,000, now we have the bank with a receivable of 3,000 and revenue of 3,000 that they have earned. All right. So receivable and payable are just the opposite of each other. Accrued expenses and accrued revenues are really just the opposite of each other. They both work the same way. And our job at the end of the accounting period is to figure out what is payable and what is receivable. If you have a loan, you're going to have interest payable because you never pay the loan exactly at the end of the year. So you're going to have some time period from the last time you paid it to when that you owe them interest. If you have employees, you're going to have wages payable because they are going to have worked since the last time you paid them. And so that expense needs to be recorded and that liability needs to be recorded. So there's almost always some accrued expenses and accrued revenues, usually more accrued expenses, that we need to make sure we record at the end of accounting period.